Bitcoin's recent drop to 110,000 has sent a familiar wave of unease across the market. For those who watch the charts daily, this sharp decline feels like a sudden storm, shaking confidence and sparking fearful conversations online. Headlines quickly filled with bearish predictions, and social media sentiment soured almost overnight. This kind of volatility is classic Bitcoin, both attractive and terrifying. Seasoned market participants step back from the noise. They know emotional reactions are poor guides for financial decisions. Instead of panicking, look to the broader context. History and data provide a map of past behaviors and recurring patterns. Examine historical trends, on-chain data, technical indicators. Together they build a structured framework for the current price action. This isn't about a crystal ball, it's about identifying signals that have shown strength or weakness before. We'll explore 5 signals that suggest this dip could precede a rebound, offering a data-driven counter to market anxiety. This turns fear into a methodical evaluation. We must ask specific, evidence-based questions. Are long-term holders selling their coins, or are they buying the dip? Do historical seasonal patterns support a recovery? Are key technical indicators flashing warning signs, or signaling the bottom is near? Focusing on these data points helps us navigate the choppy waters with a clearer head, relying on verifiable information from past cycles. The goal isn't blind optimism, risks are real. The goal is to be prepared and informed. Understanding these 5 bullish signals gives a fuller picture. It helps investors, newcomers and veterans assess scenario probabilities. This analytical mindset is crucial to survive and thrive in Bitcoin. Now, let's delve into the first important signal. First, we must consider the powerful influence of seasonality. The month of October has earned the nickname Uptober. Looking back at Bitcoin's performance since 2013, October has frequently delivered positive returns, often marking a turning point after late summer weakness or consolidation. This tendency isn't an ironclad law, but it is a strong statistical bias traders watch closely. It creates a psychological tailwind, where participants sometimes help make the rally happen. Seasonal strength rarely moves in a straight line. There's a specific intra-month pattern relevant today, October 11th. Early October often shows a final dip or a shakeout that sets a monthly low. The key tell, can price hold above that low after week 2, roughly around October 12th to October 15th. If Bitcoin avoids printing a new monthly low now, history says the path of least resistance till month end is up. That makes the current action around $110,000 a critical test. This level is the early October low the market is defending. If buyers step in to prevent a decline below it in the coming days, it would match the classic mid-month pivot pattern. Chart watchers would see that as the final pre-rally dip being complete. While past performance isn't a guarantee, the confluence of October seasonality and the mid-month low pattern offers a compelling historical analog for a rebound. Remember, it's only one piece of a larger puzzle. It's a historical observation and can fail. A major negative catalyst could override this seasonal bias, but alongside other bullish signals, it strengthens the recovery case. Traders will be watching price action intensely over the next several days, looking for confirmation the script is replaying. A successful defense of the lows would be the first major clue. Beyond price charts, seasonal trends, lies the powerful world of on-chain data, which provides a transparent look at the behavior of different market participants. One of the most crucial signals to watch during a price dip is the activity of long-term holders. These are addresses that have held their Bitcoin for extended periods, typically over 155 days, and are considered the smart money of the ecosystem. Their behavior is often a leading indicator of market tops, market bottoms. When they begin to sell their coins en masse, it often precedes a major market correction. Conversely, when long-term holders stop selling, begin to accumulate during price weakness, it is a profoundly bullish signal. It shows that the most patient and experienced market participants view the current prices as a valuable opportunity, not a reason to panic. On-chain analysts are currently observing this very phenomenon. Data from Glassnode CryptoQuant show coins moving away from exchanges into wallets with long-term holding histories. This suggests the drop to 110,000 is being met with buying pressure from a cohort that's notoriously difficult to shake. This accumulation acts as an unseen support for the market. Short-term traders leverage players are forced to sell during volatile downturns. Long-term holders absorb that supply, effectively placing a floor under the price. Their conviction stems from a belief in Bitcoin's long-term value proposition, not swayed by short-term price fluctuations. Seeing them add to positions during peak fear provides a strong counter-narrative to bearish headlines and social feeds. It is a quiet vote of confidence from the most steadfast investors. Therefore, as we evaluate a potential rebound, continued accumulation by this group is the most fundamental signal to monitor. A sudden halt in accumulation, a shift toward distribution, would be a significant red flag. But as long as seasoned hands continue to patiently stack sats, it signals that underlying demand remains incredibly strong. This provides a solid foundation for a sustainable price rally, making it a critical factor in the bullish case. Section 4. Reading the charts, technicals align. While fundamentals and on-chain data paint a broad picture, technical analysis provides a more granular view. For traders, alignment of key technical indicators can signal a local bottom. Right now, several indicators are converging, suggesting selling pressure may be nearing exhaustion. The first and most important is Bitcoin's position relative to major moving averages. Specifically, the 20-week simple moving average. That line has historically acted as crucial bull market support. A dip below it followed by a swift reclaim is often a classic fake-out that traps bears and launches a strong rally. Beyond moving averages, chart patterns show consolidation. After the sharp drop, price is trading within a tightening range. This coiling action sometimes forms a pennant, or a symmetrical triangle. These patterns show a battle between buyers and sellers reaching equilibrium. Such patterns rarely last. They usually resolve in a significant breakout. Given the other signals, an upside breakout becomes higher probability. Traders are watching closely, ready to act on a decisive move either way. Volume is the engine that confirms any price move. Price gains on low volume are suspicious. A breakout with a big spike in trading volume would strongly confirm bullish intent. It would signal many participants stepping in, overcoming seller supply. Watch for volume to rise as price tests key resistance. That's a healthy move. Finally, momentum oscillators like the RSI are giving clues. On higher timeframes, the daily RSI has dipped into or near oversold. Oversold doesn't guarantee a reversal, but suggests downward momentum is stretched. When oversold RSI lines up with strong price support, a tightening chart pattern, and bullish on-chain data, the case for an impending rebound becomes much stronger. The alignment of these technical factors is creating a compelling setup for a reversal. Section 5. Big money and macro wins. The final set of signals comes from forces outside the immediate crypto ecosystem, the macroeconomic environment, and the growing influence of institutional capital. These factors create overarching conditions that can either fuel a bull market or extinguish it. A major catalyst has been the introduction and continued adoption of spot Bitcoin ETFs. These regulated financial products have created a new persistent source of demand from large-scale investors and wealth management funds. The daily flow data for these ETFs provides a direct window into institutional sentiment. Consistent inflows, even during price dips, show that big money is using moments of weakness to build their long-term positions. Furthermore, the broader macroeconomic landscape is beginning to look more favorable for risk assets like Bitcoin. After a period of aggressive tightening, central banks around the world are signaling a potential pivot toward more accommodative monetary policy. The prospect of stable or even lower interest rates makes holding non-yielding assets like Bitcoin more attractive compared to bonds. This macro tailwind reduces downward pressure on the market and can encourage capital to flow from safer assets into those with higher growth potential. Bitcoin, with its fixed supply, often performs well in environments where fiat currencies are being devalued through monetary expansion. At the same time, we cannot forget the structural impact of the 2024 Bitcoin halving. This pre-programmed event cut the issuance of new Bitcoin in half, creating a significant and permanent reduction in the new supply entering the market. While the effects are not immediate, this supply shock steadily exerts upward pressure on price over time, especially as demand continues to grow from sources like the new ETFs. Historically, the 6 to 18 months following a halving have been the most bullish periods for Bitcoin's price, and we are currently right in the middle of that window. This fundamental supply and demand dynamic underpins the entire market structure. However, it is crucial to acknowledge that these bullish signals are not guarantees. A sudden geopolitical event, A surprisingly harsh regulatory announcement, a systemic failure in the traditional financial system. The high leverage often used in crypto derivative markets means price moves can be violently exacerbated by cascading liquidations. Therefore, while the signals point toward a likely rebound, investors should remain vigilant and manage their risk accordingly. The key is to watch if these signals hold, especially the defense of the October lows and the continued accumulation by long-term holders. The 110,000 dip is painful, but 5 signals, seasonality, mid-month behavior, accumulation, technical alignment, and macro catalysts suggest a rebound is on the table. Watch if Bitcoin holds recent lows, reclaims key trend lines, rallies on strong volume, and sees continued institutional inflows. If you found this helpful, hit like, share your outlook in the comments, and subscribe so you don't miss the next update. Want a chart-driven or on-chain deep dive version of this? Tell me below, and I'll make it next. Thanks for watching.